You're watching the extinction of a 1,000-year-old monetary asset in real time. The silver squeeze is no longer a theory. It is a mathematical certainty appearing on the balance sheets of the COMEX today. Most people believe silver is just a poor man's gold or a volatile Reddit meme trade. They think the price is set by supply and demand in a fair market. That belief is the trap. The price you see on your screen is a digital hallucination, while the physical metal is being vacuumed out of Western vaults at a rate that guarantees a total systemic break by 2026. You see, the registered inventory at COMEX has hit a 14% coverage ratio, which means for every 100 ounces of paper silver traded, only 14 ounces of physical metal exist to settle the claim. Today, I am breaking down the 3-stage extinction event happening right now: the vault drain, the strategic weaponization by the East. And the historical pattern that proves this is not a market correction. It is an imperial reset, a mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script. But your capital is your responsibility. Always conduct your own research. The number is 107.7 million ounces. That is the total registered silver inventory at COMEX as of January 27th, 2026. Registered stock is the only silver actually available for physical delivery. The rest is classified as eligible, which is a legal fiction that means the metal is sitting in the vault, but it is not for sale. You see, the exchange does not distinguish between these categories in the public price. Your brokerage app shows you the spot price of silver as if the entire vault is liquid. It is not. The registered stock, the real inventory, now covers only 14.2% of the 760 million ounces of open interest currently on the books, which means 86% of the contracts written by COMEX have no physical metal backing them. Plus, this is not a static problem. The drain is accelerating. Since the peak in September of 2025, COMEX stockpiles have vanished by 22%. That is 117 million ounces erased from the system in less than 5 months. You see, the math is no longer sustainable. At the current rate of withdrawal, the registered inventory hits zero by mid-2026. Not theoretically zero, legally zero, which means every paper contract becomes a forced cash settlement, and the price you were promised evaporates into a legal dispute over who gets paid first. Now, here is where the fine print becomes a weapon. Under UCC Article 8, the Uniform Commercial Code that governs securities transactions in the United States, you are not the owner of the silver you think you bought. You are an entitlement holder. That is the exact legal term. Entitlement holder, which means when the vault runs dry, you do not have a claim to a specific bar of silver. You have a claim to a share of whatever is left after the prime brokers, the bullion banks, and the exchange itself take their cut. You see, the COMEX is not a storage facility. It is a legal choke point. And the moment the registered stock falls below 10% coverage, which is mathematically guaranteed by April of this year, the exchange has the legal authority to halt physical delivery and force all settlements into cash at the current spot price. The current spot price, not the price silver will trade at when the system breaks. The price it trades at today, when the illusion is still intact. Plus, this is not conspiracy, this is contract law. Read the fine print of any silver ETF prospectus. It explicitly states that in the event of a delivery failure, the fund may settle in cash or substitute assets at the discretion of the custodian, which means your insurance policy against inflation, your hedge against the collapsing dollar, is backed by a legal framework designed to vaporize the moment you need it most. The vault is being drained, the contracts are being written, and the 14% coverage ratio is not a warning. It is a countdown. If the math of the 14% coverage ratio makes sense to you, then you are already ahead of 99% of the population. Join our forensic circle by subscribing. We do not track headlines, we track the fingerprints of the collapse. But even this vault crisis is a distraction from the real mechanism. Because while COMEX bleeds inventory, the East has just weaponized the entire supply chain. And the law they passed on January 1st, 2026, changes the 2026 timeline entirely. On January 1st, 2026, China reclassified silver, not as a commodity, as a strategic resource, which means silver is now in the same legal category as rare earth elements, uranium, and military-grade semiconductors. You see, this is not a trade policy. This is a weapon. And the mechanism is buried in a document called the Catalog of Technologies Prohibited and Restricted from Export, updated by the Ministry of Commerce on December 15th, 2025. The new rule is simple. Any entity that wants to export refined silver from China must now apply for a government-issued license. And only large state-owned enterprises with an annual refining capacity of 80 tons or more qualify for approval. 80 tons, which means every private refinery, every mid-tier smelter, and every joint venture that has been feeding the Western market for the last 2 decades is now legally prohibited from shipping a single ounce of silver outside Chinese borders. The data shows that China produces approximately 5,200 metric tons of refined silver per year. That is 167 million ounces, which represents roughly 20% of total global mine supply. Plus, China is the refining hub. Even silver mined in other countries, Peru, Mexico, Australia, gets shipped to Chinese smelters for purification and then re-exported as refined bars, which means the true exposure is not 20%. It is closer to 60 to 70% of the refined silver that flows into Western vaults, Western ETFs, and Western industrial supply chains. You see, the law does not ban exports outright. It simply creates a bureaucratic choke point that only state-controlled entities can pass through, and those entities answer to the Chinese Communist Party, not to the London Bullion Market Association. Which means, if you live in the West, you're now competing with a Chinese military-industrial complex for a metal that is essential for every solar panel, every AI chip, and every cruise missile in existence. Now, here's the framing you need to understand. Silver is not gold. Gold is a store of value. Silver is a strategic input. You cannot build a photovoltaic cell without silver paste. You cannot manufacture a high-frequency trading server without silver conductors. You cannot produce a hypersonic missile guidance system without silver alloys. The global energy transition, the AI arms race, and the military rearmament cycle all converge on one bottleneck, silver. And China just locked the door. Plus, this is happening while the paper-to-physical ratio has reached a critical threshold. The London Bullion Market Association, the LBMA, currently trades silver at a ratio of 300 to 1. 300 paper claims for every 1 physical ounce in the vault. You see, the LBMA operates on an unallocated basis, which means when you buy silver through a major bank or brokerage, you're not assigned a specific bar with a serial number. You're given a digital credit that says you own a fractional claim to the pool. The math only works if most people never ask for delivery. But the moment 10% of contract holders demand physical settlement, the entire structure collapses because the metal does not exist, which means the price you see on your screen, the spot price of silver trading at $28 per ounce as of late January 2026, is not the price of silver. It is the price of a promise. And the promise is breaking. The proof is in the backwardation signal. In October of 2025, the silver futures market hit a 20% annualized backwardation rate. Backwardation is a black magic term that most retail investors have never heard, but it is the single most important price signal in commodity markets. Here's what it means. Under normal conditions, the price of silver for delivery in 6 months should be higher than the price of silver today, because you have to account for storage costs, insurance, and the time value of money. But when backwardation occurs, the price of silver today is higher than the price of silver later, which means the market is screaming that there is a physical shortage right now, and traders are willing to pay a premium to get their hands on metal immediately, even if it means accepting a lower price in the future. You see, backwardation does not happen in liquid markets. It happens when the banks are desperate for physical delivery to cover their short positions. And a 20% annualized backwardation rate is not a minor anomaly. It is a systemic fracture. Plus, the timing is not random. The backwardation signal appeared in October. China announced the export restriction in December, and the registered COMEX inventory started collapsing in November, which means the vault drain, the Eastern weaponization, and the paper market breakdown are not separate events. They are 3 stages of the same extinction sequence. Now, layer in the 2026 maturity wall. The first quarter of 2026, January through March, represents the largest cluster of short-dated silver derivative contracts in the history of the futures market. The exact figure is 432 million ounces of open interest, set to expire between February 10th and March 20th. You see, these are not speculative bets by retail day traders. These are institutional hedges written by the bullion banks to suppress the price and manage their exposure to physical demand. But here's the problem. When those contracts expire, the counterparties have the legal right to demand delivery, and the banks have 2 options. Settle in physical silver, or settle in cash at the current spot price, which means if the registered inventory at COMEX falls below the 10% threshold before March 20th, the exchange will invoke force majeure, halt physical delivery, and trigger a cascading wave of cash settlements that obliterates trust in the entire paper silver market. Plus, the industrial buyers are not waiting. Solar panel manufacturers in the United States and Europe have already begun stockpiling refined silver at levels 30 to 40% above normal operating reserves. AI server farms are pre-purchasing silver conductor paste in bulk contracts that lock in supply for the next 18 months, which means the physical offtake, The actual metal being pulled out of circulation for productive use is now competing directly with the financial offtake. The metal being pulled into vaults by investors who see the maturity wall coming. You see, this is the strategic extinction. The East has weaponized the supply, the West has financialized the demand, and the physical market is being crushed between two opposing forces that guarantee a break. The registered inventory is at 14%, the paper ratio is at 300 to 1, the backwardation rate is at 20%, and the maturity wall hits in 60 days. The math is no longer theoretical, it is a countdown. But even this mechanism, the vault drain and the strategic choke point, is just the surface. Because this exact pattern has happened before, not with silver futures and Chinese export licenses, but with Roman denarii and imperial debasement. And the cycle dictates that what comes next is not a market correction, it is a monetary reset. In the year 211, the Roman denarius was 98% pure silver. It was the backbone of the largest empire in human history. Soldiers were paid in denarii. Taxes were collected in denarii. Trade across 3 continents was denominated in denarii. The coin was trust. The metal was proof. By the year 270, the denarius was less than 5% silver. It was a bronze core with a thin silver wash that rubbed off in your hands. The empire did not announce the debasement. They simply diluted the coinage year after year, replacing real metal with base metal until the currency collapsed and the empire fractured into 30 separate kingdoms within a single generation. You see, Rome did not fall because of barbarians. Rome fell because the money died first. Today, we do not wash our coins in silver. We wash our balance sheets in digital silver, exchange-traded funds, unallocated accounts, fractional reserve bullion banking. It is the same fraud, just executed with fiber optic cables instead of Roman mint workers. The denarius was debased to fund wars and grain subsidies. The LBMA 300 to 1 paper ratio is designed to suppress the price and fund the derivatives market. The mechanism is different. The outcome is identical. Plus, the math proves we are already in the debasement phase. 2025 was the 5th consecutive year of global silver deficit, a cumulative shortfall of 820 million ounces, which means the world has consumed 820 million more ounces of physical silver than it has mined over the last 5 years. You see, that number is not an estimate. It is the hard balance between supply and demand published by the Silver Institute and verified by industrial offtake data from solar manufacturers, electronics producers, and military contractors. 820 million ounces is nearly equal to a full year of global mining production, which means we have effectively borrowed an entire year of future supply to meet current demand. And the deficit is accelerating. The driver is not jewelry, the driver is not silverware, the driver is artificial intelligence and renewable energy. A single AI server farm requires 2 to 3 times the silver content of a traditional data center. You see, AI chips run hotter, they require more thermal management, and silver is the most thermally conductive metal on the periodic table. Which means every data center, every GPU cluster, and every edge computing node being built to support the AI arms race is a silver sink. Plus, solar panels now consume 30% of all mined silver, up from 10% a decade ago. The global energy transition is not theoretical. It is happening right now. And every gigawatt of solar capacity installed, every electric vehicle manufactured, and every grid-scale battery deployed pulls physical silver out of circulation permanently, which means the deficit is not a cyclical downturn. It is a structural trap. Now, here is the part that guarantees the break. 70% of silver is a byproduct of lead, zinc, and copper mining. Silver is not mined on its own. It is extracted as a secondary recovery when companies dig for base metals, which means the supply of silver is tied to the demand for copper and zinc, not to the price of silver. You see, even if the price of silver hits $500 per ounce, miners cannot just turn on the tap, because increasing silver production requires increasing copper production. And if you flood the market with copper, you crash the copper price, which makes the entire mining operation unprofitable. It is a physics trap, not a market correction. Plus, the lead time to bring a new mine online is 7 to 12 years. Environmental permits, infrastructure development, refining capacity, which means the supply side cannot respond to the demand shock happening in 2026. The metal that will be needed 3 years from now should have been permitted 9 years ago. The cycle does not care about exceptionalism. The math is already locked in. This is where Gresham's law becomes the execution mechanism. Gresham's law states that bad money drives out good money in circulation. You see, when a government debases the coinage, people hoard the old pure silver coins and spend the new diluted coins because the bad money is accepted at face value, while the good money retains intrinsic worth. The law was written in 1558, but it applies perfectly to 2026. Paper silver is bad money. Physical silver is good money. And as the vault levels hit the dead zone, as the registered inventory at COMEX falls below 10%, as the LBMA paper ratio stretches to 400 to 1, the good money is being driven out of circulation. You see, the bullion banks are not stupid. They know the maturity wall is coming. They know China has locked the supply. And they are quietly accumulating physical metal while selling paper contracts to suppress the price. Which means by the time the retail investor realizes the ETF is a legal fiction, the vaults will already be empty. Plus, the precedent is documented. In 1980, the Hunt brothers attempted to corner the physical silver market. They accumulated over 100 million ounces. The price spiked from $6 to $50 in less than 4 months. The COMEX responded by changing the rules. They implemented a silver-only rule that banned new long positions and forced liquidation-only trading. The Hunt brothers were bankrupted. The price collapsed. But here's what the history books do not tell you. The reason the exchange changed the rules was because the physical metal did not exist to settle the contracts. The paper market was already running on a fractional reserve. And the moment someone demanded delivery at scale, the system broke. That was 1980. The paper-to-physical ratio was 20 to 1. Today, it is 300 to 1. You see, the cycle dictates that empires do not collapse because they run out of power. They collapse because they run out of money. And money dies when the unit of account becomes a unit of fraud. Rome debased the denarius. America financialized the silver market. The metal is real. The paper is a promise. And when the vault hits zero, the promise evaporates. The cumulative deficit is 820 million ounces. The AI and solar demand is non-negotiable. The supply response is physically impossible. And Gresham's law guarantees that the physical metal will be hoarded while the paper burns. This is not a trade. This is a trap that has been set for 50 years, and the timer runs out in 2026. The vault is at 14% coverage. The paper ratio is at 300 to 1. The export licenses are locked, and the maturity wall hits in 60 days. Most people will ignore this data and pay the price. But if you're the type of person who refuses to be a victim of the script, if the math of the 14% coverage ratio makes sense to you, then you're already ahead of 99% of the population. Join our forensic circle by subscribing. We do not track headlines. We track the fingerprints of the collapse. In our next investigation, we will examine Executive Order 6102, the legal precedent that allowed the government to confiscate gold in 1933, and why the next iteration may not just come for your gold, but your private digital keys. Here is the forensic warning. Silver is the Achilles heel of the entire global financial script. It is the one asset that cannot be printed, cannot be synthesized, and cannot be replaced by a central bank digital currency. You see, gold is a store of value. Silver is a strategic necessity. And the moment the paper-to-physical ratio breaks, the price will not rise gradually. It will reset. Not to $100, not to $200, to whatever price clears the physical market when trust in the paper system evaporates overnight. And by then, the vaults will be empty. The registered inventory will be allocated to the prime brokers. The ETFs will settle in cash, and your unallocated account will become a legal dispute that takes years to resolve. The cycle has played out before. Rome, Spain, Britain. The only difference is the speed. Fiber optic cables move faster than Roman roads. You have the data, you have the timeline, you have been warned.